Welcome to the Interactive Brokers Introduction to Mutual Funds course. In Lesson 1, we will define what a mutual fund is. We will discuss the different types of funds, such as active and passive funds, open-end and closed-end funds, and no-load funds, as well as no transaction fee funds. And we will cover some of the benefits and things to consider. In the next lesson, we will delve into mutual fund pricing and how and where funds can be bought and sold. In our final lesson, we'll explain how mutual funds are traded at Interactive Brokers and how funds can be transferred. After each lesson, there will be a brief quiz. When you've completed the lessons, there will be a final exam to help you measure your progress. Now, let's get started. What is a mutual fund? In this lesson, we will explain what mutual funds are, discuss the different types of mutual funds, and explore the potential benefits and considerations of investing in this type of investment product. For starters, a mutual fund is an investment that combines your money with money from other investors. The combined pool of money is used to buy shares in various securities, such as stocks and bonds. These securities make up the fund's portfolio. The combined money is professionally managed by the fund's portfolio manager. Every shareholder may gain profits and incur losses in equal portion. Each share in the mutual fund represents an investor's part ownership in the fund. Types of mutual funds. Mutual funds come in many flavors. Let's cover the choices. Equity funds invest in stocks. When you own stock, you own part of a company. Fixed income funds buy investments that pay a fixed rate of return, such as municipal bonds, mortgage-backed bonds, and corporate bonds. Money market funds invest in short-term fixed income securities, such as treasury bills, certificates of deposit, bankers' acceptances, and commercial paper. Balanced funds invest in a mix of equity and fixed income securities. Index funds aim to track the performance of a specific index, such as the S&P 500. And specialty funds can focus on sectors, such as real estate or technology or healthcare, or they can have a specific mission, such as socially responsible investing. Funds of funds, like the name implies, are mutual funds that invest in other funds. Active versus passive management. Now, let's explain active versus passive management. Active management. With an actively managed mutual fund, the portfolio manager buys and sells securities and attempts to outperform the return of the overall market or other benchmarks. A benchmark is a standard against which the performance of a security, mutual fund, or investment manager can be measured. Passive management. Passive management involves buying a portfolio of securities designed to track the performance of a benchmark's index. The mutual fund's holdings are only adjusted if there is an adjustment in the components of the index. Open-end versus closed-end mutual funds. There are two categories of mutual funds, open-end funds and closed-end funds. Open-end funds have an unlimited number of shares and are priced at the end of each trading day. Closed-end funds have a set number of shares whose price may fluctuate throughout the trading day. To invest in a closed-end fund, there must be shares available and you must buy an existing share. These funds trade like equities. Benefits. One of the biggest benefits of investing in mutual funds is that investors will get broader diversification, as one fund share may contain dozens of underlying stocks, bonds, or a combination of both stocks and bonds. A mutual fund is generally overseen by a portfolio manager who has expertise in investment selection. The portfolio manager may also have a research team to assist them. Another perk is that you don't have to pick securities and manage your own investments. And you can often start investing in mutual funds with a very small initial investment. Considerations. Before investing in mutual funds, consider if they are an appropriate investment for you. It's important to consider what your goals are. For example, are you investing to pay for college, buy a home, fund your retirement, or another large future expense? You should also consider your time horizon. Think whether the fund is likely to achieve your goals within your time frame. Also think about your personal risk tolerance. Consider which fund has the appropriate risk level for you. And consider the tax impact. Think about what the tax impact of the fund's yield may be, or consult a tax advisor to help you determine the tax impact. And remember, all investments are risky and you can lose your principal. Now we have completed Lesson 1. You can measure your progress by answering the quiz questions for this lesson.